Hello, welcome back to Chapter 4, Managing Money. Today we are going to be talking about savings plans and investments. Remember, pause and rewind, pause and back up, pause. Always a great thing when you're watching a math video. Here we go. Let's talk about the formula. So when you're saving up, things like your retirement plans, your investment plans, things like that, right? You want money in the future and you have a little bit extra now and you want to save up for the future. But like it's a retirement account where you make a regular monthly contribution. All right, so this N value here, this N tells us that they are regular payments. So whatever your payment is, your future amount will be the payment that you pay monthly, quarterly, whatever, times this fraction. And this fraction is kind of huge. Let me erase that bit there, though, because I want to make sure we can see this. 1 plus APR over N to the NY. This whole thing right here, that's the compound interest formula, right? You know the compound interest formula from Unit 4B. So it's that same formula we used here, but we're taking it apart, kind of. We have a payment out in front. That minus 1 is our numerator. And then just the APR over N in our denominator, all right? Accumulated savings balance, the regular deposits we make, the regular annual percentage rate, number of compounding periods per year, and the number of years that it's being compounded. Here we go. Let's go forward instead of backwards. Life is always good when you're not looking behind you. Here we go. Use the savings plan formula to calculate the balance after 6 months for an APR of 12% and monthly payments of $100. Oh my goodness. Okay, let's look at a couple of things. 6 months. So the number of years is 1/2, or in this case, I'll probably use a 0.5. An APR of 12%, remember 12% is in decimal form, 0.012. Monthly payments of $100. So we extract these words that guide us to the values that we're going to need. Here we go. Our formula is payments of $100. Formula just says parentheses, double parentheses, 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 1 plus 0.12, our APR, over monthly. Right? Notice the 1 is not in the denominator. Decimal divided by denominator. To the power of monthly for half a year, right? Only the 6 months, minus 1, monthly, 12% monthly. Your calculator will hold this entire thing. Type it, don't use the dollar sign. 100 times, parenthesis, parenthesis, 1 plus 0.12 divided by 12, close parenthesis. Use that power thing, right? It's called a caret. I call it an up arrow. In parentheses, we'll put our exponent, monthly times 1/2 a year. So you can do 12 times a half or 12 times 0.5, or maybe you already know that 6 and you can use 6. Minus 1, close parentheses, then divide, and then start over again. So when you're entering this in your calculator, you go top and roll it around. And once you hit the fraction bar, enter the fraction bar, and then start again left to right. If you do these and simplify each little stage instead, we'll end up with $615.20. So we have put $100 away every month for 6 months, right? Half the year. We're earning 12% interest. We're already up to $15.20 after half of a year of that interest. All right. You would like to retire 25 years from now and have a retirement fund from which you can draw an income of $50,000 per year forever. How can you do it? Assume a constant APR of 7%. All right. So we need to know if we draw an income of $50,000 per year, right? That's the payment we want to us. How much money do we have to have in order to get that? Well, we're assuming an APR of 7%. The $50,000 must be 7% of the total balance. What? Okay, here we go. The total balance, I want $50,000 a month. that it's being paid out at 7%. So I want, because this goes on forever, I never want that to go away. I want $50,000 to always be the amount of the interest that I always get paid to me. And if $50,000 is 7% of something, it's 7% of $714,286. In other words, if you have a balance of about $715,000, you could withdraw $50,000 per year and never touch the principal because that $50,000 is all interest. Let's assume you will try to accumulate this balance, this $715,000, by making regular monthly deposits into a savings plan. We have an APR of 0.07, 7%, monthly deposits for 25 years, right? While I work, I want to get this set up. I need to get to that money. Here we go. What did we do here? Think about this. A equals PMT times, I'm going to call this big fraction or big parentheses divided by little parentheses, right? That's our general formula. So what we're doing to get payment by its side, I'm going to multiply both sides. I'm going to change this color. I'm going to remember how to change this color. Ah, yes, that's too bad, isn't it? Let's make it blue. Never going back to red now. So we multiply both sides. We'll do LP, the little parentheses, divided big parentheses times A equals payment. All right, I multiply by the reciprocal. So my little parentheses, that should be A times APR times N, APR over N. Again, this whole thing, it's multiplication. There's no addition or subtraction going on here. It's an incorrect symbol. That's not add over the big parentheses. All right, everything in there looks good. We did the operation of multiplication here, even though the slide said add. They correctly used multiplication. And notice that this is just the decimal version of the stuff inside of the parentheses of the big parentheses. If you deposit $883 per month at 7% interest over the next 25 years, you could set up an account continuing at 7% where you withdraw $50,000 every year for life until death. And then somebody else has to deal with that $700,000 and they love you so much because you gave them money. Sometimes that's all we need, people. That's all we need. Okay. Consider an investment that grows from an original principal P to a later accumulated balance A. The total return is the percentage change in the investment value. So your total return is the accumulation minus the original principal. Right? So the extra you got divided by the original principal, and then we multiply it by 100 to turn it into a percentage. If an investment grows from original principal P to a later accumulated balance A in Y years, the annual return is the annual percentage yield, APY, that would give the same overall growth. Our annual return is our future amount divided by our principal to the power of 1 over the number of years minus 1. Now, another way of writing this is let years be the root. So it's a 1 over y power is a Wythe root. It's a weird way to say it though. All right, let's look at example 3, mutual fund gain. You invest $3,000 in the Clearwater Mutual Fund. Over 4 years, your investment grows in value to $8,400. That's awesome, it grew. What are your total and annual returns for the 4-year period? Now my total return takes my future amount, $8,400, subtracts the $3,000 I invested, and then divides by the 3,000. So $8,400 minus 3,000, that's $5,400 that we gained, divided by 3,000. Looks like that is, what is that, 5,400, it's 1.8, times 100 is 180%. So we gained back 180% of the money we invested. right? Our return, we still have that 3,000 in there. Our return was 180%, almost double, almost 200% of what we invested. Awesome. Annual return, the 84,000 we had in the future divided by the 3,000 we had originally is our internal fraction. The power, 1 over 4 years, so 1/4. That's the fourth root. When we divide, we get 2.8. So the fourth root of 2.8 minus 1 is 0.294. And that, when we multiply it by 100, is 29.4%. All right, what does this mean? That didn't all summarize it. Our total return was 180% of what we invested, and our annual return was 29.4%. Excellent. Now let's move forward again. Types of investments. Cash investments generally earn interest and include the following. In cash investments, nobody's going to turn away cash, generally. Money you deposit into bank accounts, that's a cash investment. Certificates of deposit, cash investment. You generally find these at banks and other financial institutions. U.S. Treasury bills, you can invest in the U.S. government if you dare. We might have a bond or a debt that represents a promise of future cash. You buy a bond by paying some of the principal amount to the issuing government or corporation. Let's consider it the U.S. government. The issuer, the government, pays you simple interest, as opposed to compound interest. They're like, hey, here's $10 a year. Thanks for the money. And then the government, the issuer, promises to pay back your initial investment plus interest at some later date. So they're like, hey, thanks for this $10. Here's $1 a year for you for letting us use this $10. But after a few years, let's call it 7 years, the government says, hey, thanks for that money. Here's your $10 back. And here's a little bit of gratitude, quote, interest, for letting us use it. All right, so that's what's happening with a bond. Whereas a stock or equity gives you a share of ownership in a company. A bond is really you're just giving somebody else a low-cost loan. A stock, you're trying to make money. Invest some principal amount to purchase the stock. The only way to get your money out is to sell the stock. Stock prices change with time, so the sale may give you either a gain or a loss on your original investment. The key here when you own stock is to never sell low. Buy low, sell high. All right, but it could do anything it wants, and all of those 15 years your money is sitting there. If you have a stock, all that matters is the day you purchase and the day you sell. That's the only time the stock market can hurt you. I hope. Unless it takes all your original money and then you're just out of luck, I think. Like, oh, hope you had fun playing. Okay, let's look at liquidity. An investment is liquid if you can get your money out. Cash investments, very liquid. Savings accounts, checking accounts, very liquid. Treasury bonds, CDs, they're not very liquid. You need to consider the risk. Is your investment principal at risk? If I invest $5,000, am I guaranteed to always have that $5,000, or could I lose a portion of that? That matters. And the return, how much return, whether it's total or annual, can you expect on your investment? If I let you borrow this $5,000 and I have this $5,000 I'm not using, it's just sitting there, how much can I earn from that? Would I be better off upgrading my car so I can make more money at work? You know, you never know what you need to do with your various investments and your money to make it work for you. The Dow Jones Industrial Average, the Dow Jones reflects the average prices of stocks of the 30 largest companies. And it's generally pretty steady. There's ups, there's downs. There's always ups, there's always downs. When things get up too high and too out of control, something like the stock market crash in 1929, right? October in 1929, things got pretty rough here in the U.S. and we could see everything crashed. And then it started building up slowly. We could see here a little bit of troubles as things were building. We have a little bit of World War II going on. Things are building, it comes down a little bit. I bet we could see the Korean War here. building. Things are up, things are down. We had the gas crisis in the late 70s. It was a little rough. Things are building. 19 like the world changed, I got to tell you. From 80 to 90, it's a whole different world. Building, everything's looking pretty good. Got a little shaky here. And right before 2010, here in 2008, we had our stock market crash, which things got ugly. And then now it's building again. A couple of things to notice. It always goes up. It always has a moment of, uh-oh. And this is getting right with the world. It was growing too fast, too out of control. There was no way this pattern was keeping up. So it bottomed out and it started again. Oh, let's slow this growth down. Oh, we're getting crazy. And it starts all over again. And so stock prices, not surprising whatsoever. All right. In general, there are two ways to make money on stocks. Sell a stock for more than you paid for it, right? So you have a capital gain. You made money. Or you can make money while you own the stock if the corporation distributes part or all of its profits to stockholders as dividends. So if you get dividends, you can make money on stocks before you sell them. All right, let's look at a stock quote. Let's look at Microsoft. I'd venture a lot of us are probably on a Microsoft product or Apple. I mean, it's really that, right? Answer the following questions by assuming that figure 4.6, this image below, shows an actual Microsoft stock quote that you found online today. Okay, so we have the symbol. It tells us the change. It tells us the price per share at the time that this was shown. It tells us how it opened, the highest during the day, the lowest during the day, so you can kind of see where it went. Over the past week, over the past year, how high has it been? How low has it gone? So we're at the highest. We're at the pretty close to the high for the last year. So that's interesting. We have the percentage change in share price before the day's close. The volume of shares that have been traded today. That's volume over here. Market cap, price to earnings ratio, dividends. Like if anybody got dividends in the last quarter, they got 56 cents. Woo! Dividend yield, shares that are outstanding. All right, so all these different parts of a stock quote. Here we go. We're going to look at 5 different parts of this, and I'm not going to go through all the questions. We'll go through the questions kind of as they come. So what is the symbol for Microsoft stock? As shown at the top of the quote, Microsoft Corporation has the symbol of MSFT. All right, it's always abbreviations, Microsoft. Usually they're so you can figure out who the company is, but it's nice to sometimes have those names next to them. Sorry, the next question. What was the price per share at the end of the day yesterday? The end of the day yesterday is how we open the day today. All right. Question C. What's the volume? Actually, what are we looking for? What's the value of shares that have been traded today, I believe, is the question. The volume shows that 25,263,000 shares of Microsoft were traded today, whatever day this was. At the current price of $240.97 per share. So we take the volume, the number of shares that have been traded today, and we multiply it by the price per share, and that is hundreds, thousands, millions, billions, 6 billion. $88 million were traded in Microsoft on this particular day. So how many? Right? Like, how many shares were traded? Let me find the question. What fraction of all Microsoft shares have been traded so far today? So how many shares have been traded? E, suppose you own 100 shares of Microsoft. What dividend should you expect this year? All right, let's just get those questions out of the way. So let's take the volume, all right? The volume of shares traded today. And we'll divide by the number of shares outstanding. Notice that's in millions. Very important to keep a look at the millions. So we are going to divide 25 263 by 7,542 million. So we divide this fraction and we end up with this decimal. Does that seem reasonable? Very much so. 0.0033. If we move our decimal 2 places, we'll end up with 0.33% of all shares have traded today. That's not much action. 25 million shares have been traded, but it's less than 1% of all of the outstanding shares of Microsoft. Now, if at my 100 shares at a price of $240.97, my shares are worth $24,097. My goodness, words matter. The dividend yield is 0. That's not true. That 0 is not there. 0.93%. So that you would earn. All right, let's see if they did this math correctly. I didn't catch that the first time. It moves twice. They actually did the correct calculation. We just have an extra 0 here. I apologize for that. All right, the 0.93 used correctly here as 0.0093. When I multiply that back, I should make $224.10 in dividend payments this year. And I got to tell you, it's nice to have dividend payments at the end of December. Get some money after any holidays, after the semester has robbed you of all your money. All right, let's look at bonds. Bonds are issued with 3 main characteristics. They have the face value or par value, and it's the price you pay to buy the bond. The coupon rate of the bond is the simple interest rate that the issuer promises to pay. So if somebody tells you a coupon rate, you automatically know it's a bond, and you automatically know it's simple interest. The maturity date is the date on which the issuer promises to repay the face value of the bond, right? You bought it, $100, whatever it happens to be, they're going to pay you back on this date. So the current yield is the annual interest payment divided by the current price of the bond. Let's look at an example. The closing price of a U.S. Treasury bond with a face value of $1,000 is quoted as 105.97 points for a current yield of 3.7%. If you buy this bond, how much annual interest will you receive? We'll take this points. Points is just a fancy financial term for percentage. So 105.97% is 1.0597 times 1,000. And that 1,000 just moves the decimal 3 times. And that's how we get $1,059.70. All right, this percentage moves it 2, and then times 1,000 moves it 3 back, so we end up just moving the decimal in place. The current yield is the annual interest divided by the current price. Notice if I multiply the current price on both sides, then I'll have annual interest by itself on this side, because current price will cancel out, and I'll have current price times the current yield. Right? And it's an equation. It doesn't matter which side we write them on. They're balanced. They're the same. So our annual interest is 3.7% in decimal form, times that $1,059.70. So my annual interest is $39.21. All right. So I'm going to get my interest payments, and then they're going to pay me back on the maturity date. Nice. Let's look at mutual funds. When comparing mutual funds, the most important factors are the following: the fees charged for investing, which they very rarely tell you, and how well the funds perform. Now, although this is very important, past performance is no guarantee of future results, right? You get somebody new in running Fox Sports, and all of a sudden they can't show any NFL games anymore. That's going to affect your investment in Fox Sports. Mutual fund quotations. Let's take a look here. The NAV, the net asset value, is essentially the share price. So that's how much it costs for each share in the fund. the fund name, and you could get investors about this. The ticker symbol, if you want to look at your mutual funds. Year-to-date return, annual returns over the past 1, 3, 5, and 10 years. And they're all annualized. So we're using the APY so that they can be compared no matter how long that is. Let's take a look. Based on the Vanguard 500 mutual fund quote shown on the previous slide, how many shares will you be able to buy if you decide to invest $3,000 in this fund today? Let's go back. I know the price per share is $361.25. I want to invest $3,000. To find the number of shares you can buy, divide your investment of $3,000 by the share price, which is currently $361.25. I could buy 8.3 shares in the fund. Cool. Now I know how much I have. Here's hoping we all have money that we can invest. The risk of losing it is not scary, and that when we come out on the other side, we do something fun and helpful to all of humanity. All right. Yeah, I don't have money to invest either. Thanks for listening, though. Bye.